Why is it so hard to stay consistent with our financial goals? You set a target to save, invest, or pay off debt, but before you know it, life gets in the way. We all have big financial dreams, but how do we make sure we don't fall off track? In today's video, I'm going to share with you the top 5 ways to stay consistent with your financial goals. These strategies are simple but effective, and they can help you keep your financial progress on track without feeling overwhelmed. Ready to finally make consistent progress? Let's dive in. 1. Build automated financial systems. Let's start with one of the most effective ways to stay consistent with your finances: building automated financial systems. If you're like most people, making financial decisions every month can lead to fatigue and emotional overspending. That's where automation comes in. By setting up automatic transfers, you ensure that your savings and investments are prioritized before you even see the money in your checking account. For example, you can set up recurring contributions to your savings or investment accounts directly from your paycheck. This removes the decision-making process altogether and eliminates the temptation to spend that money elsewhere. Moreover, you can create if-then rules for any extra income you receive. Let's say you get a tax refund. Instead of spending it, you can set up a rule that says, if I get a tax refund, then 50% goes directly into my emergency fund. But that's not all. Another great way to automate your finances is to auto-increase your savings every time you get a raise. Imagine that every time your salary increases by 5%, your savings contributions automatically increase by 1%. This ensures that you never fall into the trap of spending more just because your income grew. Over time, this system will automatically help you save more and live within your means without feeling the need to consciously track every penny. Automation makes saving effortless, and this consistency will snowball into substantial wealth over time. 2. Designate a weekly money review. Strategy number 2 is to set aside time for a weekly money review. Most people only check their finances once in a while, maybe when they're preparing for taxes or in response to financial stress. However, the key to financial success is consistency, and dedicating just 20 minutes every week to review your finances can make a huge difference. On Sunday evenings, carve out a short amount of time to check your spending from the previous week and plan for any upcoming expenses. This ritual helps you stay on top of your finances, ensuring there are no surprises, and it allows you to make small adjustments along the way. By regularly reviewing your spending, you'll also spot areas where you can cut back, like canceling unused subscriptions or reducing impulse buys. Moreover, a weekly money review gives you the opportunity to track your progress on your financial goals. You'll be able to see how much you've saved, whether you're on target to reach your goals, and identify any unnecessary spending patterns that you can improve. Instead of obsessing over every penny, use tools like Fidelity's Full View or Monarch to track your overall spending patterns. This will help you see where your money is really going and how you can optimize it to stay on track. 3. Add strategic friction to spending. Moving on to strategy number 3, adding strategic friction to spending. This concept is simple but incredibly effective when it comes to building long-term wealth. The key to consistent saving isn't just about cutting down on spending. It's about making impulsive purchases harder to make while making saving easier. The less convenient it is to spend impulsively, the more likely you are to stick to your financial goals and avoid those unnecessary purchases. Start by removing your saved payment info from shopping websites and apps. You might not realize how often you make spontaneous purchases until you remove that easy one-click payment option. By forcing yourself to manually input your credit card details each time you want to buy something, you give yourself a moment to pause and reconsider. This small but effective step adds friction between you and your purchases, giving your rational mind time to catch up with your emotional impulses. For larger, non-essential purchases, implement the 48-hour rule. If you're eyeing something that costs more than $50, commit to waiting 48 hours before buying it. This delay allows the initial excitement of the purchase to wear off, and by the time the 48 hours are up, you might find that you no longer feel the need to buy the item. This simple strategy helps you focus on what you truly need and reduces those spontaneous, impulse buys. The beauty of this method is that it doesn't eliminate fun purchases entirely. It just ensures that you're more intentional with your money. 4. Narrow your focus to 2 to 4 SMART goals. Now, Let's talk about the importance of narrowing your focus to just 2 to 4 SMART goals. It's easy to feel overwhelmed when you're juggling too many financial goals at once. If you try to tackle everything all at once, your attention gets scattered and your efforts get diluted, which makes it harder to make meaningful progress. That's why the most successful people in managing their finances choose to focus on a few, clearly defined goals rather than spreading themselves too thin. Instead of setting vague, broad goals like save more money or get out of debt, make sure your goals are SMART, specific, measurable, achievable, relevant, and time-bound. For instance, rather than saying, I want to save money for a house, refine it to something more concrete like, save $5,000 for a house down payment by end of year. By defining your goals this way, you create a clear, actionable roadmap. You know exactly what you're working toward, and you can break that down into manageable steps. Whether that means saving $500 a month or cutting certain expenses, you can create a plan that aligns with your timeline. Experts often recommend that you focus on the 3 core financial pillars before moving on to other financial goals. Building a starter emergency fund, paying off high-interest debt, using the avalanche method for efficiency, and contributing consistently to retirement accounts. Once you've got these basics under control, you can start branching out to additional goals like saving for a vacation or starting an investment portfolio. The more specific and focused your goals, the easier it will be to stay on track without getting distracted or overwhelmed. Clarity and simplicity are key to successfully achieving your financial objectives. 5. Prioritize foundational resilience. Lastly, let's discuss the importance of prioritizing foundational resilience. Consistency with your financial goals becomes much easier when you're not constantly being derailed by unexpected financial crises. Building a solid financial foundation will protect you from emergencies and help you stay on track when life throws curveballs. The first step is to rebuild your emergency fund. Ideally, you want to have 3 to 6 months of essential living expenses saved up. A high-yield savings account, HYSA, is a great place to park this money, as it earns competitive returns while remaining easily accessible in times of need. It's also crucial to regularly review your insurance and estate plans to ensure they match your current lifestyle and assets. Whether it's life, health, or property insurance, regularly checking your coverage can prevent costly gaps in protection. You don't want to find yourself underinsured when an unexpected event happens. Another key element to foundational resilience is celebrating small wins. Financial progress takes time, and when you reach a milestone, whether it's paying off a credit card, saving a certain amount, or sticking to your budget for a few months, celebrate it. Rewarding yourself helps keep your motivation high, making it easier to stay on track for the long haul. There you have it. 5 powerful ways to stay consistent with your financial goals. These strategies aren't about extreme sacrifices or impossible standards. They're about setting yourself up for success with systems that make financial progress the default without requiring constant willpower. By automating your finances, regularly reviewing your spending, adding friction to impulsive buys, narrowing your focus to SMART goals, and building foundational resilience, you'll create a roadmap for long-term financial success. The key to staying consistent is not about being perfect every time, but about making progress each day. Start small, stay focused, and build momentum. If you follow these strategies, you'll find it much easier to achieve your financial dreams. If you found these strategies helpful, be sure to like, share, and subscribe for more tips on managing your finances and achieving your financial goals. Let me know in the comments which strategy you're going to implement first and how it's going to help you stay consistent with your financial journey. Thanks for watching, and I'll see you in the next video.